Hi, welcome to Dig Into China. I'm Qiang. Thank you for tuning in. If you enjoy what you see, don't forget to hit the like button, share with your friends, and subscribe. Your support means the world and plays a crucial role in the YouTube algorithm. Liking, sharing, and subscribing not only show your support, but also help YouTube recommend my videos to a broader audience. Thank you very much. During the recent two sessions, Chinese Premier Qiang delivered a pivotal government work report. A noteworthy announcement included the initiation of issuing ultra-long-term special government bonds for consecutive years, commencing this year. These bonds aim to address the financial requirements of significant projects crucial for the nation's development and the process of national rejuvenation. The funds raised will be specifically allocated for the implementation of key national strategic initiatives and the enhancement of security capabilities in vital areas. The initial issuance this year will amount to 1 trillion yuan, and it will not be counted towards the national fiscal deficit. Kindly focus on three specific expressions in the upcoming year, ultra long term, and not factored into the deficit. Reflect on the significance of these three terms. It's quite intriguing. First and foremost, this is government debt. Regardless of the type of debt, borrowing money occurs when one's income cannot cover expenses. The primary reason people borrow is because they lack funds in their pockets but need to spend. Similarly, for a country, it has a plethora of financial tools. Only when absolutely necessary and perhaps when resources are exhausted with no readily available financial instruments to alleviate the situation will a special government bond be issued. It's important for everyone to recognize that the funds generated from the issuance of these government bonds played a pivotal economic role during the Chinese Civil War. A major economic factor contributing to the defeat of Chiang Kai-shek's nationalist forces on the mainland was the persistent and excessive issuance of special government bonds. This ultimately resulted in the devaluation of the currency, with the gold yuan losing its value. Since the establishment of the People's Republic of China, the Communist China, there have been a total of 5 instances of issuing special government bonds. In the late 20th century, precisely in August 1998, the first instance of issuing special government bonds occurred, totaling 270 billion yuan. These funds were utilized to address the non-performing assets of the 4 major state-owned banks. It's noteworthy that the repayment of this special government bond was facilitated by the growth in foreign trade. The second occurrence took place 17 years ago, in 2007, when special government bonds totaling 1.55 trillion yuan were issued. These bonds were intended to serve as the capital for the China Investment Corporation, the nation's sovereign wealth fund. However, this debt was not completely paid off. Subsequently, new debts were issued with a portion of the proceeds allocated to fulfill the repayment of this initial government bond. 4 years ago, in June 2020, during the 7th year of the leadership of the esteemed leader Xi Jinping, the third issuance of special government bonds took place. This 1 trillion yuan bond was specifically issued to combat the COVID pandemic. As the pandemic persists, the repayment period for this government bonds is yet to arrive, leaving the 1 trillion yuan outstanding. 9 years ago, into the leadership of the esteemed leader, in December 2022, the fourth issuance of special government bonds took place, amounting to 750 billion yuan. A portion of these funds was directed towards settling previous debts, adhering to the practice of using new borrowing to repay old obligations. In October of the previous year, during the 10th year of the leadership of the esteemed leader Xi Jinping, the fifth issuance of special government bonds occurred, totaling an additional 1 trillion yuan. Currently, Premier Qiang has declared the sixth issuance of special government bonds, with an additional 1 trillion yuan slated for release in 2024. Therefore, there have been a total of 6 confirmed special government bonds issuance. Notably, 4 of these occurrences transpired during the leadership of Xi Jinping. Specifically, these issuances took place in 2020, 2022, 2023, and the most recent one in 2024. It prompts reflection on the significance of having 4 issuance transpires within a mere 5-year period under the leadership of Xi Jinping. The overall fiscal revenue for the Chinese government stands at around 20 trillion yuan. Across Xi Jinping's leadership, the 4 instances of special government bond issuance amounted to nearly 4 trillion yuan, representing approximately 1/5 of the total government fiscal revenue. It's crucial to understand that the base of this fiscal revenue, exceeding 20 trillion yuan, used to rely on key industries. However, recent information from the Central Economic Work Conference report at the end of 2023 indicates the absence of these foundational industries. In the past, real estate served as a pillar industry, but it no longer holds that status. The origin of government fiscal revenue has become considerably uncertain. Regarding emerging industries, sectors like electric vehicles and new energy storage, where Xi Jinping concentrated efforts, were considered pillars as of 2022. However, they were excluded from the Economic Work Report last year because these industries were unable to contribute substantial revenue to the government. Instead, they incurred costs without corresponding financial gains. In the current landscape of China, the government faces a challenge with decreasing revenue, escalating expenditures, and predominantly inflexible costs. Notably, there is a growing expenditure on maintaining public order, exemplified by the increasing expenses for law enforcement. Moreover, rising costs are associated with the maintenance and the service of previously invested infrastructure and public facilities. Expenditures on the salaries of civil servants and employees in public institutions, coupled with the annual growth in social security spending, contribute to the widening gap between income and expenditure. The annual increase in social security spending is driven by the addition of over 10 million retirees last year. These factors collectively lead to an expanding disparity between expenditures and income, with the spending on the rise and income on the decline. Despite this significant gap, there is a notable absence of visible revenue from any core business activities to offset this deficit. The recent 2 sessions in China have made it clear that the central government is planning to rely on borrowing for its future expenditures. However, a crucial backdrop for this strategy is that there is no control or reduction in the current levels of local government debt, urban investment bonds, significant undisclosed debt, and off-balance sheet liabilities. The debt volume remains unchanged or even increases, and the existing debt from before is becoming increasingly challenging to repay. Faced with the significant debt burden, a new term enters the scene: continuous. What does this imply? It means that not only in 2024 does the nation plan to rely on borrowing for financial sustenance, but for the forthcoming number of years, continuous borrowing is projected as an ongoing necessity, with the borrowed amounts expected to escalate. Why is this becoming a trend? The widening gap between income and expenditures is a key factor. The debts from 2020 remains outstanding, yet new borrowing initiatives have already commenced. With a total issuance of 4 trillion yuan, equivalent to 1/4 of the national fiscal revenue, the country lacks the capacity to repay these debts using its current income. The current government fiscal revenue is already stretched thin, allocated towards essential expenses such as pensions, social security, civil servant salaries, and stability maintenance costs, leaving little room for debt repayment. Local governments and urban investment bonds continue to expand, relying on continuous debt issuance for 1 trillion yuan each time. The question remains, how will these debts be repaid? Thus, the strategy of continuous borrowing is essentially a means of pushing potential risks into the future. The upcoming years are poised to witness an uneasing cycle of borrowing, giving rise to a novel term, ultra-long-term government bonds. Government bonds are traditionally categorized as the short-term, medium-term, and the long-term. Special government bonds issued previous never ventured into the realm of an ultra-long-term. They were typically labeled as a long-term special government bonds, with repayment periods already extended to 10 years or more. Anything lasting 10 years or more is generally considered long-term. However, a novel term has surfaced, ultra-long-term. Presently, the exact duration of these ultra-long-term bonds remains uncertain. Will it be 20 years, 30 years? Nonetheless, one thing seems likely. For someone of my age, investing in these ultra-long-term government bonds might mean not living to see the day of redemption. The true nature of this ultra-long-term remains uncertain, and we will need to await an explanation from the Chinese Communist Party. The continuous use of ultra-long-term becomes even more puzzling when considering that these ultra-long-term government bonds are not included in the deficit. What does this imply? Essentially, on the financial statements of the Chinese government, these bonds won't be recognized as liabilities. They are intentionally left out. Why are these funds not accounted for as liabilities? There may be two potential implications widely known among many in China, though discussions on the matter are often restrained due to its straightforward nature. It is widely acknowledged because the issue is relatively uncomplicated. Firstly, this is done to create an aesthetically pleasing financial report, ensuring the fulfillment of the 5% economic growth target in 2024. Consider this. On one hand, the government bonds issued are excluded from the financial statement, yet the borrowed funds are allocated to local production and manufacturing efforts. Through this strategy, a 5% GDP growth for the current year can be realized. By keeping the borrowed funds off the financial report, it effectively shifts income to local governments, allowing them to invest in production and contribute to GDP. Can such a financial report not look favorable? However, who could be fooled by such tactics? Most people recognize the underlying reality. The second implication of not including special government bonds in the deficit is that the Chinese Communist Party fundamentally does not view this amount as part of the debt, and there is no plan to repay it through the fiscal system. Why? Because China operates under a unique authoritarian system with one-party rule, the CCP can opt not to treat the special government bonds as an obligation that the government is obliged to repay. In contrast to foreign governments where government-issued bonds are inherently tied to the government's responsibility, in China, the CCP might potentially detach these special government bonds from the government itself. Rather than the government taking on the repayment, the People's Bank of China might directly address it by printing additional money. Consequently, these bonds are not factored into the deficit calculation. In reality, during the two bond issuance in 2022 and 2023, a notable buyer, particularly in the 2023 issuance, was the People's Bank of China, or the central bank. This is because many other Chinese banks are grappling with significant bad debts, leaving them financially strapped. The financial reports of numerous banks reveal substantial liabilities, with some even facing the possibility of bankruptcy. If you expect these banks to purchase government bonds, they lack the financial capacity to do so. In this scenario, the central bank can directly print money to acquire the ultra-long-term special government bonds, making it a logical course of action. When the time comes for repayment, the central bank can settle the debt by printing additional money, and as a result, it doesn't need to be treated as part of the deficit. Hence, in this instance, the emphasis is not on utilizing financial institutions' leverage tools to magnify the so-called money multiplier. Rather, the central bank is authentically printing money to acquire government bonds. If the Chinese government utilizes the money freshly printed by the central bank to distribute funds downwards, it might address the issue of a scarcity of tangible currency in society. However, the most immediate outcome is likely to be a swift devaluation of the purchasing power of the Chinese yuan. A more direct consequence would be a substantial drop in the exchange rates of the Chinese yuan against many foreign currencies. Take the exchange rate against Japanese yen, for instance. Given the current scenario where the Bank of Japan is poised to raise interest rates, a remarkable shift from the trend of rate cuts seen in the past 40 years, this move is anticipated to attract a substantial inflow of various international currencies into Japan. Consequently, the flow of US dollars into China is expected to decrease further, leading to heightened tension. The likely outcome of this Japanese interest rate hike for the yuan, which is presently undergoing rate cuts, is straightforward: a swift and substantial depreciation. Let's observe how the yuan's exchange rate unfolds following the announcement of the Bank of Japan's interest rate hike. Hence, a 20% or even more devaluation of the yuan is deemed quite ordinary as the 1 trillion ultra-long-term special government bonds are issued this year. Nevertheless, these exchange rate fluctuations are not the primary concern. They are merely anticipated phenomena in the future. The true importance lies within the core of the issue. It resides in the transformation of a country's fiscal model, shifting from relying on income to meet expenditures to depending on borrowing for expenditure fulfillment. Such a shift indicates the imminent risk of financial collapse for the country. Once the pattern of continuous issuance of ultra-long-term government bonds, or the money printing model, is initiated, it becomes an unstoppable force. Social income will rapidly dissipate, exacerbating wealth inequality, and the newly printed money will disproportionately accumulate among the affluent, leaving the ordinary citizens bereft. Numerous industries will suffer severe blows, and the potential for societal unrest will experience an exponential surge. Many Chinese citizens may argue that there is currently robust consumption in the domestic society with a significant number of affluent individuals. I'd like to emphasize that the economic well-being of a city is closely tied to the success of local government officials. As the business and income of these officials prosper, so does their influence, creating a multiplier effect within the surrounding system that contributes to the overall economic vitality of the locality. In many cities, the economic prosperity is intricately likened to the income of local government officials. Linked. For more urban areas, ordinary citizens no longer have clearly defined source of income, and there are no dominant business or core industries. The appearance of prosperity in a city often hinges on the substantial earnings and the spending habits of government officials. The thriving ecosystem built around the services for government officials creates the illusion of a prosperous city. However, if these officials lose the capacity to spend and consume, the city may experience a notably grim situation. Thus, I contend that in any city where the economy is thriving, there are invariably numerous government officials enjoying a prosperous life. The current approach of the Chinese Communist Party involves relying on borrowed funds for expenditure, causing considerable harm to private enterprises. When local governments start depending on financial assistance from the central government, their reliance on higher authorities intensifies. This heightened dependence results in greater demand for debt and an increased burden of debt. In the end, this may lead to two potential outcomes for China. Firstly, resembling the strategy adopted by the nationalist government in the past, there might be an excessive printing of currency to fill the substantial debt gap, resulting in a significant devaluation of the Chinese yuan. This could potentially lead to China withdrawing from the international market, converting the currency into one solely utilized by the Chinese population. Secondly, the central government may bear the load, assuming the debt burden. This would lead to a scenario where the government's assets fall short of its debts, ultimately resulting in a declaration of bankruptcy. These are essentially the two outcomes. Is there a third possibility logically? Yes, there is. The third scenario envisions the emergence of a new foundational industry in China, one with the potential to drive substantial productivity and efficiency. Through the rapid growth of this significant industry, it could give rise to a new system encompassing numerous sectors, accumulating assets surpassing 50 trillion yuan. This would catalyze rapid economic growth, enhance societal confidence, contribute to increase the tax revenue, gradually recuperate the funds borrowed by the central government, and eventually restore the nation to a more balanced income expenditure model. However, we all know that the third local path is fundamentally impossible to occur in China. Thank you for watching. Please like, leave a comment, and subscribe to my channel. Just click the subscribe button right here. I'll see you again shortly. Until then, be well.